Welcome to our comprehensive overview of the financial system. In today's world, financial markets play a vital role in supporting economic growth and stability. They serve as platforms where various financial instruments like bonds, shares, and derivatives are traded, ensuring that resources are allocated efficiently and liquidity is maintained for businesses. Whether you're an investor, a student, or simply curious about how economies function, understanding financial markets is essential. In this video, we'll break down the types, functions, and significance of financial markets, with a special focus on the Indian context and recent reforms. Financial market is essentially a business environment where different types of securities, such as bonds and shares, are bought and sold. These markets operate at lower transaction costs, making it easier for investors and companies to participate. Financial markets are crucial for the smooth functioning of a capitalist economy, as they help in the allocation of resources and provide liquidity to businesses. The flow of capital between investors and those seeking funds is efficiently managed, ensuring that money is put to productive use. Financial markets are more than just places to buy and sell securities. They help economies function smoothly by allocating resources and creating liquidity for businesses. These markets enforce transparency, which helps set fair and efficient prices. Macroeconomic factors such as taxes can influence market values, sometimes making them differ from their intrinsic worth. Major financial markets like the New York Stock Exchange handle trillions of dollars in trades daily, showing their immense scale and importance. Financial markets work hand in hand with institutions like mutual funds, insurance companies, and pension funds. Together, they facilitate the flow of investments and savings, which supports the production of goods and services. These institutions, along with the markets, contribute to economic growth by meeting the demands of investors and the broader economy. Their combined efforts help mobilize funds and channel them into productive venture. There are several types of financial markets, each serving a unique purpose. Stock markets allow companies to list shares for trading, helping them raise capital through IPOs. Over-the-counter markets are decentralized, enabling direct trades between parties without a central exchange. Bond markets let investors lend money to governments or corporations for a fixed period, while money markets deal in highly liquid short-term holding. Derivative markets involve contracts based on underlying assets, and forex markets handle currency trading with the highest liquidity worldwide. Stock markets are platforms where organizations list their shares for public trading. Investors and traders buy and sell these shares, and companies use initial public offerings, IPOs, to raise capital. Stock markets are essential for companies seeking to expand and for investors looking for opportunities to grow their wealth. The process is regulated to ensure transparency and fairness for all participants. Over-the-counter OTC markets are decentralized and do not have a fixed location. Trades are conducted directly between two parties, often without the involvement of a broker or agent. While most stock trading happens on exchanges, OTC markets are crucial for certain types of securities and offer flexibility for participants. This setup can be especially useful for smaller or less liquid securities. On markets facilitate the borrowing and lending of money through the issuance of bonds. Governments, municipal corporations, and companies issue bonds to raise funds for various projects. Investors lend money for a fixed period at a set interest rate, and bonds are typically issued as bills or notes. This market is vital for funding large-scale financial projects and infrastructure development. Money markets specialize in short-term, highly liquid financial instruments. These markets are considered safer with lower returns compared to other markets. They allow organizations and traders to manage their short-term funding needs efficiently. The scale of trading in money markets is significant, especially at the wholesale level, making them a crucial part of the financial system. Derivative markets involve contracts whose value is derived from underlying assets like stocks, bonds, or commodities. These contracts can be complex, but they play a significant role in risk management and speculation. By linking the value of derivatives to primary securities, these markets provide opportunities for hedging and leveraging investments. Foreign exchange or forex market is where currencies are traded. It is the most liquid market globally, as cash is the most liquid asset. Major participants include banks, commercial organizations, and investment management firms. The forex market operates 24/7, reflecting the global nature of currency trading and its importance in international finance. Financial markets serve several key functions. They mobilize savings and channel them into productive investments, determine and settle the prices of securities, provide liquidity to assets, and make trading accessible to all types of participants. By bringing buyers and sellers together, financial markets reduce the time and resources needed to find trading partners and ensure that information is readily available. One of the most crucial functions of financial markets is mobilizing funds. They collect savings from individuals and institutions and invest them in productive ventures. This process supports capital formation and economic growth, ensuring that resources are used efficiently across the economy. Financial markets play a vital role in determining the prices of various securities. Prices are set through the interaction of supply and demand among investors. This dynamic process ensures that securities are fairly valued, reflecting the latest information and market sentiment. Liquidity is essential for the smooth functioning of financial markets. Investors need to be able to convert their assets into cash quickly and easily. Financial markets provide this liquidity, allowing participants to buy and sell securities without significant delays or losses in value. Financial markets make trading efficient by bringing buyers and sellers together in one place, whether physical or virtual. This reduces the effort and resources needed to find trading partners and ensures that all participants have access to necessary information. As a result, trading becomes more streamlined and accessible. India's financial sector has undergone significant growth and reform, especially since the early 1990s. The sector plays a crucial role in capital accumulation and the production of goods and services. However, developing countries often face challenges like limited markets and poorly defined legal systems, making it harder to raise capital efficiently. Reforms have aimed to address these issues and enhance the sector's contribution to economic development. The appointment of the Narasimhan Committee in 1991 marked a turning point for banking reforms in India. Key measures included deregulating interest rates, reducing the cash reserve ratio, and allowing more foreign and private banks to operate. These changes increased competition and enabled banks to raise additional funds through capital markets, strengthening the sector overall. Reforms in India's capital markets included removing government approval for market access, establishing the Securities and Exchange Board of India (SEBI) in 1992, and allowing foreign institutional investors. The introduction of electronic trading and the National Stock Exchange (NSE) modernized the market, making it more efficient and accessible for companies and investors alike. These reforms led to a surge in initial public offerings, IPOs, and increased participation from various industry segments. However, while the banking sector reforms significantly promoted economic growth, the development of the stock market did not have the same impact. In India, the banking sector remains more influential than the stock market in driving economic progress. Capital markets, often referred to as stock markets, have a long history. They have evolved over time, adapting to the needs of investors and market participants. Regulatory bodies ensure fair play and transparency, preventing misuse of information for personal gain. The capital market is essential for linking savers with investment opportunities. Capital markets are divided into two main categories: the primary market and the secondary market. The primary market deals with new securities issued for the first time, while the secondary market is where existing securities are traded among investors. Both markets are crucial for the efficient functioning of the financial system. Capital markets serve as a bridge between savers and investment opportunities, enabling long-term investments and capital formation. They help intermediaries like brokers and banks conduct business and operate under government regulations, making them a safe place for trading. These features make capital markets attractive to both investors and companies. Main instruments in the capital market include shares, debentures, and bonds. Shares represent ownership in a company and are divided into equity and preference shares. Debentures and bonds are debt instruments that allow companies and governments to raise funds for long-term projects. Each instrument has its own risk and return profile. Equity shares are issued by companies to raise funds. Holders of equity shares have voting rights and can influence corporate decisions. However, in case of bankruptcy, equity shareholders are the last to receive any remaining assets after all debts are paid. Equity shares offer the potential for high returns but come with higher risks. Preference shares provide holders with a predetermined dividend, making them less risky than equity shares. However, preference shareholders do not have voting rights. In the event of company liquidation, they are paid before equity shareholders but after debt holders. This makes preference shares a middle ground between equity and debt instruments. Sweat equity shares are issued by companies to employees or directors at a discount or as a reward for their contributions. This form of compensation recognizes the value of know-how, effort, or expertise provided to the company. Sweat equity is a way for businesses to reward and retain key talent. Debentures and bonds are long-term debt instruments used by companies and governments to raise funds. Debentures are backed by the company's credit, while bonds may be secured or unsecured. Investors receive regular interest payments and the principal amount at maturity. These instruments are generally transferable and offer fixed returns. Money market deals with short-term financial assets, typically with maturities of less than 1 year. These instruments are highly liquid and serve as substitutes for cash. The money market is essential for managing short-term funding needs and is made up of institutions like commercial banks and non-banking finance companies. Key money market instruments include treasury bills, certificates of deposit, commercial papers, bankers' acceptance, and repurchase agreements. Each instrument serves a specific purpose, from government borrowing to corporate short-term funding. These instruments are characterized by short maturity periods and high liquidity, making them attractive for managing cash flow.